All securities and orders are discussed and tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockRoad.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors or in such capacities, licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary by accessing this webinar. You agree to hold the above harmless. Many losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, we're good to go. That wasn't cockpit, that was airplane. You guys couldn't hear that well? That was from the movie Airplane that John was talking about earlier when he said over, under. Anyway, on to reality. So if I play, it's weird, because if I play something on my computer, you guys can't hear it. Probably could hear it if I played it when I'm sharing, though. All right, well, we're not going to mess around with that today. I am now going to share my desktop, and hopefully you'll see something interesting. Let's see what happens. Oh, there it goes. You're seeing something very not interesting. You're seeing my WebEx screen. Okay. There we go. That should be more interesting. Now we're looking at some stocks. And we will open up the chat box so I can see what people are saying. And now we're in good shape. Okay, so very exciting. We had Janet Yellen saying absolutely nothing to Congress today, although, well, she did say something. What she said, let's take a look at the dollar. What she said is she said that they're really not going to raise rates. They're not going to raise rates until they give you plenty of warning, and even then they're still going to dither about whether or not they're going to raise rates or not. So there's no sudden rate increases up ahead. That has sent the dollar down a little bit, making it a little bit weaker. And let's see, here's a dollar, and here's a TLT. We'll take a look at that. This is treasuries. These are 20-year notes that it tracks. Oop. And they have, and TLT is shot right back up. And we were just talking about that before, and we last shorted it, I guess, with 135. What did we do? TLT. Maybe I'm confused. Yeah, I forgot what number I said, but I think I said the wrong number before. Yeah, I said 105. Sorry about that, Tara, if you're on. I meant 135. So if TLT gets over 135, which is soon, actually, we're going to be kind of interested in shorting it again. It's a really good short there. It has a very good chance of pulling back. Let me get a chart up for you. I'll show you what I mean. And it's just flying right now. So see, we did this short. When it punched up here, we actually started shorting about here at 130, and that's why we're going to wait a little bit longer now because we were too early. But we shorted here, we kept shorting it, and then we caught this really nice downturn here, and that's what we want to do. So when it comes back up to in this 135 area, that's where we want to get short and look for a pullback of at least 5 points off of that. So that's going to be a nice little move. And if we look ahead, I mean, you can start looking at options now. So you know it's going to get interesting. But if you're on the money, so let's say the 130 puts, and you want to give it at least a month, so you want to move out to April, give it a month to calm down. See, these are 375 on the money. That's a lot. That's why when we did it last time, we went for like a bear put spread. And that's the other reason we want to wait till it's higher. If I were to do it to the 130 line, you could buy the 135s for like $7.50. You see, they were $8.50. It punched up so hard today, it's already $7.50. So you could do these for $7.50, buy them, and then you sell like the 130s, let's say, for about $4, and that puts you in for $3.50 on the $5 spread. It's not thrilling, but you know it's $3.50, and if it calms down and stays below 130, as TLTs want to do. I mean, if you got to look at the bigger picture. How long do you think it's really going to sustain a move up here? You're talking about less than 2% on 10-year notes at this kind of level. So if that's not likely to last, then you got a good chance of coming back below this line, and your $3.50 turns into $5, and you make $1.50 in 2 months. Which is what, like, I don't know, it's like 40% or something like that. It's good money. You don't need to go for giant gains every time. Sometimes you can just make like a little bit of money with a sensible bet. So that's one to take. And the reason I like a bear put spread in that case is because if it does move against you, like let's say we thought that was a really good idea here, right? And we got burned. Let's say we were here and we got burned, and it still hasn't come back to where we thought. And we had taken let's say we had taken the April 130, 125 spread for the same, what I say, 350? Well, you see, the thing about this is, even though the 125s are 150 and the 130s are, let's call it $4, okay? So this spread is down. First of all, the spread's only down to 250. So you only lost $1 even though it went massively against you, right? That's not thing number one. Thing number two is you only paid $3.50 for the spread, but you still have $4 of value in the 130 puts that you own. So you can take that and you can roll yourself out to a longer month, preserving the value, preserving your $4. Now, if you put $3.50 into this spread, you still have the short 125s, but you're covered with these, and all you're going to do is roll them out to a longer period of time, give yourself more time to be right. So you can pick up the June's 130, and that's only $2 more, or you can, at the same time as you're doing that, you can spend $4 more and move up in strikes, the 133s or the 134s. And you actually have you still have that gap. You widen it, and I wouldn't. I would start off lower. I'd spend the $2 and I'd wait for the other guys to expire, because by the time those guys expire, you'll be able to sell another pair, another short put for another $2, and now you're going to knock. You still have the same net $3.50 in the trade. So when you spend $2 on the roll, now you're net $5.50 in the trade. But then when you sell another put for $2 down the road after the other ones expire, you're back to $3.50 on the spread. So you've got the same spread. You have a longer period of time, and now you have more time. Well, if you think it's still going to happen eventually, that you're going to get the sell-off, you're getting more time for free. Who doesn't want that? And when you do it in stages, it's actually not a big deal, because if I rolled first and spent the extra $2, if TLT suddenly went down, I can still roll the short calls. The short April 125s are 150, right? So then I look at June and say, what's 150 in June? That's all the way down to the 120. So I could roll those down to the 120s. I'd end up with a wider spread. So I spent $2 to roll to July, and if it goes up on me, I don't care, because I'm just going to sell more puts, because those short April puts will expire worthless. But if it does go down and those puts go in the money, that's not a problem for me, because I still have my $5 spread, and I can then roll the April puts to a wider, lower June strike for an even roll. So you see, you always have to think of your trade as like still in motion. It's not a fixed thing. You always can adjust it and look to make beneficial adjustments and do something and take advantage of a move. You don't have to sit there and stare at it like a deer in the headlights, which is something I was saying to somebody earlier about a trade. You can't just stare at a trade and hope something good's going to happen. You adjust it. You invest your money. If you're not willing to put more money into a spread and fix it and put it in a better position, you should probably be getting out of it. Don't stay in a spread you're not willing to put money into. You shouldn't. You're already past your. If you feel like that, you're already past your limit. At no point should you ever be in a spread that you don't have money ready to put more into. There's no such thing. You should be cutting back. Your decision needs to be: I'm either going to be moving to a position where I have a plan to put more money in, or I'm going to cut my losses now. You don't go into a position and say, oh, now my back's completely against the wall and I can't put any more money into this trade because it's 30% of my portfolio or some bullshit like that. That's a terrible way to trade. You're just trading yourself into a corner when you do that kind of stuff. All right. Well, thank God there are no questions. I don't have to stop and talk to anybody. All right. Wow, look at all this stuff. So on the whole, we're up a little bit across the board. The NASDAQ actually stopped going up. The Russell is down a little bit. That's a nice dip in the Russell. What the heck? Oh, I see. It's not I was going to say, that's crazy. There we go. That makes more sense. I don't know why. Every time I reset this system, it pushes those things over to the side. There we go. Okay, now we're looking more normal. So oil's at 50. Well, not a very exciting long here. It's a good long. I mean, you can go long here and stop out at 50. It's always, oh, this is a good point about the futures. When you're making a futures bet, the thing you want the most when you want to enter a futures position, if you want to have a good entry point. So, if we're looking at oil, the reason I want to go long at 50, well, first of all, I have a long bias, all right? But the reason I want to go long at 50 is because 50 is, as you can see, a fairly significant point of resistance. It does go up and down, but not drastically. It kind of hangs around this channel mostly. And that means if I go long at 50 and I stop out at like 49.95, I'm only going to risk losing about $50 per contract. But I do have a pretty good chance of like 50 finally warming up and it's heading higher, especially as we move to the 1 hour before the close. The NYMEX closes at 235. So it's a good spot to go long if I want to go long. I'm not, as I just said, I'm not enthusiastic about going long right now on oil. Oil, it's too early in the month, and it's too unpredictable, and we don't know what's going to happen. So it's not really a good time to pick one in either direction on oil. In fact, most of the futures are kind of tricky right now. We got one more day of Yellen speaking, and then we'll see what happens after that. But what we did do today that was very important, let's see. That's today, okay. Very important move we did make today, if I can find it, is we changed TZA. I haven't officially made the move in the short-term portfolio yet. I got to put it in. I thought I did anyway. There it is. All right. So with Russell at 1235, I liked it for a short. For the Russell Index, that was back at what time was this? 10:39. So 10:39, when the Russell was punching up over here, and this is what we talk about all the time, right? It's like I know what it's worth. So when I see the Russell going up through 1235, that's the time I'm going to call a short. I'm not waiting to see, I'm sure it's 1039, right? 1039, right there. So, I didn't call it short the second it went through, but right after it gets up there and I watch it for a few minutes, I go, you know what? That should be it. That's enough for this index. And so rather than run away and rather than capitulate or anything else, what we did is we took advantage of the move up, which we thought was unsupportable. And what we did is we then added to our position. So in the short-term portfolio, now let's look. Actually, it's good that it hasn't been changed yet because I'll show you what we had. Where is that short-term portfolio? So in the short-term portfolio, we have this 100 April TZAs. I didn't like the way they were deteriorating. They're still at 120. I didn't like the way they were kind of falling apart. And I was worried. So I said, well, you know what? Why don't we take advantage? Because if these are cheap, then the July ones are cheap, right? So why don't we just buy more time, buy more insurance, extend our insurance policy? So we rolled those to the July, I don't even know what. I forgot now. What were they? Oh, the July 9. So we spent $1.10. This is a good deal. We spent $1.15 to roll from these, and I'll show you on this thing, TVA. So we have the April one. They're more than 120 now, but they were at the time they were 120, or we figured we can get 120, which obviously we did. So we took these for 120, and then we rolled into the July 9s, and they are now 170. So it's what? No, 9. Sorry, the 9s are like 230 now. So it's still about the same 115, or it's actually 110 right now to roll. Now, so what are we doing? First of all, we're buying 3 months, right? We're buying May, June, and July. So we now bought 3 months of additional protection. And we bought another dollar in strike, and that dollar is in the money. You know, we rolled our April 10s down to the July 9s for $1.10. So we spent $1.10 to buy $1 of a better strike that's in the money, and that means that it improves our delta. It means the delta here, and I didn't have to look, but I can tell you this delta is 80, and therefore the April delta is less than 80. The April delta is 72. So we improved our delta. We get more money for each move up now, and we also bought ourselves time, so we decreased our theta decay. In other words, every day now, instead of losing, well, it's 50 days versus 143 days. It's significant, actually. We almost tripled our time. So the time decay on the premium that we have in that option has now gone down by almost a third. So we get a lot less taken off every day because of the eroding amount of time that we have, and we have improved our position by $1. What does that also do for us? It makes it easier. We haven't done it yet. It makes, I'm sorry, we did. It makes it easier for us to sell calls, because now we're further in the money, so we can sell a call and not be worried about if we get called away. So that was the second part of this thing that I'm doing. So I said we can roll into the July 9 calls. We also had 50 TZAs from another spread. Let's see if we can show you that. So we have these naked TZAs. We rolled those to the July 9s. And then I said, well, wait a minute. I also have these April TZAs. See, this was a spread of April, and we had 50 of those. So I said, well, I had no sense in leaving those hanging out. So we rolled these to the July 9s also. So now we rolled 150 TZAs to the July 9s. Don't forget, we're only spending $1.10 though, and we're rolling down $1 in strike to $1 better position. So we decreased the amount of premium that we're paying for by rolling to a lower strike as a percentage of the contract, and we've drastically increased the amount of time that we're covered. At the same time, we're leaving these guys hanging, the March 13 calls. They're pretty dead already, right? I'll be thrilled, obviously, now that we're in the July 9s, we'll be thrilled if TZA goes up to 13. So that's a non-issue. I don't have any concern whatsoever, because we now have 150 July 9 longs. And so if TZA shot up like a rocket and went to 20, all that would happen is we get called away for at least a $4 net on 50 of our 100. So that's not an issue. There's no problem there, right? There's zero worry about that happening. $4 is more than we put in for the total spread, so none of that's a problem. It's a little profit. We would obviously like to make more, but that'll be fine if it happens. So that's a non-issue. Since we did spend 150 times 15,000 times $1.10, so we spend about $16,500 total on the rolls. We're going to get a little bit back, and so what we did, we already sold these. We already collected $2,500 selling these, but now we're going to collect another $2,000, and I decided we're going to sell 50 of the what did I say? Where? There it is. And I said we're going to sell 50 of the March 11 calls for 40 cents. So then we go back to March now. Now these expire very soon. But this is how we fund our rolls. So now we said, wow, look at that, they're already 45. So we sold these March 11 calls for 40 cents on that roll. That brings another $2,000 in. Now think about that, that's March. And this is now February. So logically, this 24 days away. So logically, when these guys expire, then we'll easily be able to sell another at least 2,500, probably more like $4,000 in April. And it doesn't matter what right now. It's just a matter of saying you can probably sell 4,000 in April, and then you can sell 4,000 in May and 4,000 in June. And all of a sudden we paid for the entire row. And if we never hit our, and we're only 2/3 covered doing this, if we never hit our mark and it never goes up, all we're going to do is at some point we're going to roll those Julys back to September or October. So it's like playing leapfrog. It's like we're constantly adjusting our insurance positions to make sure we're in a good position for the insurance. And keep in mind, this is a trade that's gone very, very much against us. But it doesn't matter because we're only spending the cost of the insurance. The net cost we put into the trade is the cost of the insurance. So originally, where is it? Originally, taking this April spread, this spread was $1.10 originally. All right, so this is the same thing I was talking about in that other trade. We're taking $1.20 back out of the trade. We spent nothing. We spent $1.10 first. Now we're spending $1.20, but we're taking $1.20 back out. We're leaving these guys to hang out to dry. They're going to expire worthless most likely. And now we're taking our $1.10 back, and so there's no cost so far. It hasn't cost us anything. And now we're moving to a July insurance policy using the same money we already spent. So if you manage these trades well and you adjust them correctly, you end up with very, very cheap insurance. Let's call it a maintenance cost of your insurance. Your initial cost of your insurance, you've got to lay out some cash. But as a maintenance cost to keep that insurance active on a quarterly basis, it just requires some smart adjusting. And that's where you save yourself a fortune, because having cheap insurance on a regular basis while your long positions are making money. And don't forget, that's the other thing. In our long-term portfolio, we're setting ourselves up to win as long as the market is flat or up. Even a little down doesn't bother us in the long-term portfolio. But the way we create our positions, because we're being the house and we're selling all that premium, the way we set up those positions is all we care about. If the market is flat, we win. If the market is up, we win. We don't care which. And the only way we can lose is if those short-term portfolio positions that are bearish are winners. The only way we can lose any money in the long-term portfolio, not lose money, the only way we cannot make money in the long-term portfolio, not have a positive result in the long-term portfolio, is for the market to go down. And the only way the market can go down would be the indexes are going to pay off and we're going to make money on the short-term portfolio. So one or the other will make cash. There is no in-between with this concept, and that's very important too. Okay, because it's like life insurance, right? Because if you're alive, generally, until you retire, you're making money. So the life insurance policy that you have, it's not a waste of money, because you're not just best betting you're going to live, because you're betting you're going to live and continue to garner an income. And so if you do live, then you're paying off more, you're hopefully earning more than the policy costs you, and you'll net positive by living. If you die, the policy will pay more than you would have earned during that period, and or at least cover earnings or whatever, you know what I mean. It would cover the income that you would have earned, and at least it mitigates the disaster of you dying. Not for you, but for other people. It's the funny thing about life insurance. It doesn't help you at all. So this is the same kind of concept, okay? It's life insurance for your portfolio. We have these long-term positions that are going to make us money because we sold premium against them. They're going to make us money as long as the market stays firm. As long as it doesn't go down, and even if it goes down a little bit, they're still going to make us money. So there is a way we can win-win, because if the market goes down like 5% or 10%, our long-term portfolio is still going to make money. Not as much, but it'll make some money, and our short-term portfolio will make money. But there's no way we lose on both sides. That just really can't possibly happen the way we set these positions up. And if you can never lose on both sides, but you can win on both sides, and you usually win on the side you wanted to win on, the long-term portfolio side, when the market goes up or it's flat, those are a lot of ways to win. And that's the way you want to have your portfolio set up, right? It's not really even so much a matter of, on a regular basis, unless there's something really drastic happens in the market, it's pretty much really not a matter of whether you're going to win or lose, just a matter of how much you're going to win or lose. Things can go your way. Like last year, even though we took a lot of short positions in the short-term portfolio, we caught some good dips. And because we caught some good dips and we cashed them out, and because we cashed them out and we weren't wrong when we cashed them out, we ended up accumulating quite a lot of money. I mean, we're still up, even after this big move against us, we're still up like 100% in the short-term portfolio. Where is that thing? Oh. No wonder I can't find it right in front of me. Oh, here it is, 97%. So we're still up 97% in the short-term portfolio, even though this week has gone very badly against us. Okay, so we're very bearish here right now. We took a very bearish stance. We weren't right so far, but we're not wrong either. We're certainly not willing to capitulate. So we're actually, like I said, we're just moving ourselves back. We said already though, the S&P held up better than we thought last week. Coming into this weekend, we were worried that the market would fall apart. We were worried Yellen wasn't going to make people happy and that things would come down fast. That hasn't happened so far. So now we're not capitulating on being short. We're capitulating on the timing of being short. We now don't think that there's going to be a big fall down until maybe June when they start talking about tightening again and everybody starts freaking out. Because tightening now is kind of off the table. And that means the markets can kind of drift along and keep going. I'm still very concerned about earnings, but earnings aren't really an issue again until April, so it's not a big deal. But now we've rolled past the April earnings all the way out to July and past the June Fed meeting. All these events that we think may take down the market are now in between us and our hedges. Meanwhile, what do we do today? I said today, because we were talking about it, I said, well, now we're pretty damn bearish. In fact, look, we lost 10%. We lost $10,000 this week in the short-term portfolio. So we're pretty bearish, okay? A move up in the market of whatever the hell it just went up in a few days has cost us 10% in this portfolio. That means in our long-term portfolio, we need to be making money. And by the way, we're not, because in the long-term portfolio, we actually are flat, or not even flat. Let's see where we are. 30.5. I mean, you can't go by an intraday calculation, but basically we were at 30.5. We were at 32.5. So we actually lost 2% there too. And that's just for whatever reason. There's gyrations and so on and so forth. It's like, who knows why that happened? It really isn't important. In fact, if you want to look at one thing, the silly Apple trade, we have 20 of these $20 spreads, so they're good for $40,000 bucks, right? But it's only showing us, what, 15,000 here. Even though they're like deeply in the money. It's the 8,100 spread. It's so deeply in the money, it's only showing us 15 out of a, oh, I'm sorry, it's showing us 15 out of 40,000. So we're getting ripped off for 25,000 on this spread right now. Now, realistically, you can't buy that spread for that price. You cannot get the 8,100 spread for $15. I'm sorry, not even $15. I'm sorry, I'm saying that wrong. This is well, it's $18. I don't know why it's saying that then. It's weird because here this says 65,000 here and 49,000 here. So oh, it's the net. Oh, I'm looking at it wrong. That's why. Sorry, silly me. This is 105 minus 69. So it's actually maybe it's doing better than I thought. I was looking at this column, but that column's not really a column. Here's the column of the value of each side. So it's 105 minus 69, 36. It's actually 36 out of 40. It's almost time to get rid of that because I don't know, because now we're into the point where we're saying, do we want to wait a year to get $4,000 more dollars out of that spread to make 10%? And in a year I can make more than 10%. I can make more than 4,000 on 36,000, right? So I think we might want to start thinking about unwinding that spread, in fact, and picking up something more aggressive. Not that we didn't. We already do have more aggressive spreads. We have this Apple. Look at what we have here. We have two other spreads. We have the 110-140 spread and the 90-120 spread. So we got lots and lots of Apple positions. And like I said, though, see, these guys are in the money, and they're showing net not even 40,000, and this is a $60,000 spread, and this one is another $30,000 spread, and it's showing net 14. So you can see, like, you know, it's a funny thing to say that we only have 32% or whatever, because the reality is that if these spreads, all Apple has to do is flatline from here, and we pick up like $50,000 more dollars, which is like another almost 10% on this portfolio. You always need to be aware of those things and where you stand, because sometimes, and that's what's probably happening here, is because Apple popped up. You see how this guy's, he's up 39%, right, which is fine. It's a spread, but he's down 51%. So we lost money. We lost more money here than we gained over here, even though this spread is actually completely in the money for us. But what's happening, though, is the premium is going away from the $90 calls. They're only counting as 45 bucks. It's 135 here. But these guys have gone up from 120 and add 26 here at 146. Okay, so they've gained premium faster than our $90 calls have gained premium. Therefore, we've technically lost, on paper, lost money. Even though, and this is the thing, you have to be smarter than your broker in the portfolio they show you, because their calculation shows you that that spread is losing money. How is it losing money when Apple is going more in the money and you've got a 90-120 bull call spread? You can't possibly lose money. It can go to $1 billion. You can't lose money. There's nothing up that damages you. But what's happening at this particular moment in time, because there's so much time left on the clock, those 120 calls end up having more premium than the 90 calls that we own. So it looks like we're doing worse than we are. And that's why you got to be careful about those intraday numbers. Would I keep the Apple puts if we close the bull call spread? Probably not from a discipline standpoint, only because we would sell something else. And if we do this, we would most likely sell different puts, like the 100. At this point, I'm happy selling the 100 puts and make 10 and have $10 instead of $350. And it's just a discipline thing because there's 20 of them. So I don't want to obligate myself to buy. I'm already obligated. Whether you believe it, even if you believe it can't possibly happen, you still have that obligation. Even if you have the margin for it, you still have that obligation to buy $160,000 worth of Apple at 80 bucks. And that should bother you, even though you think it's ridiculous and you don't think it's going to happen. And even if you have $160,000 bucks, you got to say to yourself, do I really, if something really horrible happened to Apple and it completely collapsed tomorrow and it went down to $75 all of a sudden, it dropped almost 50% overnight. If something so horrible happened that killed him, do I really want to have it be 25, 30% of my portfolio? And probably not, right? I mean, realistically, even though it's Apple and even though you think it'll recover, like Boeing's a good example of that. When you obligate yourself to buy Boeing, you know what can happen to Boeing. There could be a big giant plane crash and they can ground all the planes. Either it could be terrorism or it could be some kind of malfunction that grounds Boeing's fleet and halts all their orders and causes contracts to get canceled. And it's like, yeah, whatever it is, they're going to fix it. They'll fix it and they'll turn it around and it'll be good. But you know what? I don't really want Boeing to be 20% of my portfolio or 30% of my portfolio while I wait. So I'm always very careful with Boeing when I'm owning it, right? When I'm obligating myself to have it. And you should be with any company. You always have to imagine you never know why there'll be a disaster. Look at BP with the oil spill, right? BP is a rock solid company. Same thing as owning Exxon. Rock solid company. Anybody can have a disaster. Never think your company can't have a disaster. So, the answer to that is if I were getting out of Apple entirely, I would leave them because I really would love to own Apple for 80 bucks. But if I was going to initiate another Apple play, then that 350 isn't enough premium for me to want to sell to offset a new position. But I also wouldn't want to have 40 outstanding short Apples. And notice that we don't, by the way, we didn't sell on these plays up here, if you can see. On these new bull call spreads, we didn't bother selling puts. So the answer really is yes, I would take this back, spend the $7,000 bucks to clear that out, and then we'd go to Apple and we'd say, well, what are we willing to sell? Now, since I have no obligation to buy Apple at all in the portfolio, because now we have we bought back those 20. I've got no obligation. I'm happy to own 2,000 shares of Apple, 20 short contracts, for $100. It's $200,000. But $200,000 is only $100,000 of my buying power. I don't mind that. I don't mind having $100,000 of my buying power used up owning Apple. So I'm happy to do this for $8. I'm happy to sell those hundreds for $8. And honestly, it's a weird thing because I mean, look, you get $350 for the 80s. You got to go up $20 just to get another $450 out of these guys. It shows you how unlikely people think it is that Apple's going to drop. Nobody's willing to really pay you for it. But I'd rather have that money. But also for the same thing, I really don't think Apple's going to go back below 100. And if it does, I'm going to be happy to own it. So I got no reason. And I'm not, by the way, in exchange for the extra $450, what am I risking? I'm risking owning Apple for $20 more than I already agreed to own it for. All right, and also it's not even $20 because I did collect some money from the other puts. So if you really want to think about it, what I did is I sold originally. I sold these 80s for $8, got this back, so now we're netting about $5 profit here. Then I sell the next ones for another $8. Now I've collected $13. So now, even if I sell the 100 puts, I'm already down to like $87 anyway. So I collected $13 net on the short put sale. So I'm very, very comfortable doing that. And you know, it's a sort of, you know, it's an up and down kind of thing. You have to weigh out the balance and say to yourself, well, okay, you know, I want to collect the money. Between now and 2017, why would I not want to collect an extra $450? I mean, it's the same obligation essentially, except I'm going to get burned for $20,000 if Apple does go down. So I'm collecting $9,000. And I'm sorry, $40,000. I'm collecting $9,000 more by selling $450 more puts than I have otherwise. So I'm collecting $9,000 on 20 short puts, but I'm risking losing 20 on 20 short puts is $40,000 if it all goes tits up on me. Do I feel it's a 2-to-1 risk to reward ratio? So do I feel more than 66% sure that Apple will stay above 100? And the answer is yes in this case. I feel comfortable with that bet. All right, and I feel that I would rather take that risk than collect the $350 that I get coming to me on the other side, on the short 80s. And I'm not collecting. I'm collecting that plus the additional $450. So it's not going to giving up the $350. I'm just collecting a larger amount. All right, clear? Anyway, all right, so would we keep Apple puts? Do I think TLT will revert to the annual trend yield down? TLT, wait, no. TLT goes up when the rates go down. Okay, so the question is kind of weird. So Paul said, and Paul, by the way, you think privately, please, all you guys, don't chat privately, chat to all participants. So Paul said, do you think TLT will revert to the annual trend yield down? It's confusing because I just want to make it clear. When TLT goes up, rates are going down. When TLT goes down, rates are going up. That's because the TLT notes that are held by the ETF. When the rates go up, those notes become less valuable, right? The holdings of TLT become less valuable. Just like if you own Treasury notes, you have them at X percent, right? If the rates go up, your notes get less valuable compared to the new notes because they get a better percentage. If the rates go down, your rates become more valuable compared to the new rates, which are crappy compared to yours. So you could actually give your if you're collecting, let's say you had a 10% note from from 20 years ago. If you have a 10% note and you have 10 years left of 10%, your 10 years at 10% on a 30-year note is worth more than a brand new 30-year note that's getting 3%. You get 30% in 10 years. Somebody else gets 30% in 30 years. That's no good for them. You're getting a way better rate of return. Oh, I'm sorry, you're collecting 10 times 10 is 100, and they're collecting 30 times 3 is 90%. And it doesn't compound. You get it annually. You get the amount of interest. So it's actually maybe it does compound. Sorry. Yeah, I guess it does compound somehow. But anyway, so either way, though, you're getting more money. You know, if you have a 10-year note, if you have a 30-year note with 10 years left, it's worth more than a brand new 10-year note at 3%. That's the point. So that's why TLT does that. It doesn't work the way you think sometimes. So what do I think is going to happen? I think that eventually, I think you can't just keep giving money. You can't just keep lending money for free. Even though you're only really lending it to big corporations and rich people, it still gets abused. You can see it being abused because, you know, these stupid companies are buying their own stock back at record highs. The same thing they did in 2008. In 2007, they're buying their stock at the top of the market. That's a terrible time to buy your own stock. They're not investing in R&D. They're not doing anything but buying their own stock back to make their earnings look good. That's a terrible thing to do with money. So when you give money away to rich people, they are as wasteful and stupid with it as poor people are. And that's what's going on right now. And unfortunately, though, nobody's building anything that's going to last. So we're not improving the actual economy at all, spending all this money and we're spending money and the money accumulates to debt. It's going to be a problem. We just don't know when. It certainly isn't anytime soon. You know, Janet Yellen doesn't think it's a problem. Apparently neither does anybody in the Senate think it's a problem. All right, anyway. So John says, would you keep Apple puts? We said that one. Scott says, Phil, rolling question. Yesterday you were saying good to roll on a short call is 2/3 of the money. Right now I have some Twitter stock covered with June 47 calls, sold at $3.59 each. I hope you said this to all participants. Okay. The recent run-up has put these in the money. What would be the limit? I would look to rolling here. Yeah. Okay. You know what? I don't know, because you got to look at Twitter. There's no answer to that other than looking and thinking of where Twitter's going and what you sold and so on and so forth. So you have Twitter. This is one thing I do get annoyed with you guys about this one thing, because people ask, and you know, not you in particular, Scott, just in general when I get these questions, I think everybody wants they want an answer that always happens. And that's not the case at all. The case is you got to look at Twitter and say, what do I think Twitter's going to do between now and June? Because you know you had Twitter, you sold these calls for $3.50. Okay, so first of all, 47 plus $3.50 is $50.50. So question number one is, between now and June, do you think Twitter's going to be higher than $50.50? Okay, that's number one. It doesn't matter what the price of the calls is. Okay, now with Twitter at 48, 49 bucks, you sold the 47 puts calls. You have $6 of protection. You have $6. You have 15% downside protection on your Twitter. Do you not want that? Are you so positive Twitter will be higher than where it is now that you have absolutely no need for protection on that stock? And if that's the case, why aren't you selling puts? If you're so absolutely positive that there's no way in hell Twitter can be below 47 in June, then you should be selling the 47 puts, right? You're leaving $4. They're $4. So why are you leaving $4 on the table? That's my first question. You already sold the calls. And in fact, frankly, that's also protecting you. So now if you sell these puts for $4, you're now increasing your call away from $50.50 to $54.50. And that's like 20% higher than Twitter is now. And frankly, I'd be happy with that. So if you're so positive that selling the June 47s was some gigantic mistake, it's an IRA account. Well, if it's an IRA account, then you should be being cautious in it anyway. That's pretty funny. So it's all regrets, right? I mean, you should be happy. You're going to get called away at 47. You're going to get $50.50. The stock's at 48 now. Let's see, 50.50 is another what? $1.70, right? So 1.7 divided by 48.8 is 3.4% in 115 days. So basically, you're getting about a 11% rate of return on those 47 calls as they stand now. Plus, they are giving you 15% downside protection. So the question is, what do you really want to do? Do you have any opinion as to what Twitter is going to do between now and then? Because don't forget, if you get more aggressive with this thing, look at what can you do? Well, obviously you can roll it to something else that costs $5, right? These calls are $5 now. The 47s, $5.75. So let's say they're $5.75. So what's $5.75? Well, you can roll to the January 55s, or you can roll to the holy cow. You can roll to the 2017 65 calls. That gives you another 20 to 50% upside on from where you are now. That's what you can do. But do you not think Twitter might get possibly rejected at $50? And if it gets rejected at $50, then it's going to be lower than your net price if you get called away at 47. So at some point, don't you want to actually make money? Or do you want to just constantly stop yourself from making money whenever the possibility arises? Look at this pop. You got a pop from 37 past 47, which is a very logical place to sell calls, by the way. You got a pop 37 to 47, which is what, 10 out of 37. It's like 20-something, 25% basically of a pop. Hasn't pulled back yet. The 50-day and 200-day moving averages are very, very far below. They're like 10% below where it is right now. We're worried about the overall market being weak. And you want to blow off your protection. Okay? And the reason is you're hung up on a rule. The point is not about how much in the money it is or when you should roll it. The point is, what do you think it's going to do? And I think that's perfectly adequate and good protection right now. Now, you're trying to look at the rule, which we were talking about. I said if something is 2/3 in the money, so this is not 2/3 in the money. The 47 calls are $1.70 in the money out of $5.70 in cost. That means say $4 are a premium. These calls are mostly premium. They're only they're like 25% in the money, not 75% in the money. So it's way too early to sell them, which is why I still like them, I guess. There'd be no reason on earth to sell them. It makes no sense whatsoever. You sold them for $3.59, but so what? They're not $3.59. It doesn't matter what they say they are. What matters is you're collecting. You agreed to sell Twitter for $50.50 or $50.59. You sold them for $3.59. You get paid $47 cash. You agreed to sell Twitter for $50.50. So you have a very good reason not to sell Twitter for $50.50. And frankly, I don't care how much you like a stock, you got to look at a stock and say to yourself, especially if you bought it at 35 or something like that, you say, I bought it for 40, and I'm going to get 50 for it in less than a year, which is over 20%. At some point, you got to take the damn money. Just because it hit 50 doesn't mean you should suddenly adjust your price to 60 or 70 or 80. You can't just constantly want more. This is a real company with real earnings. Did Twitter do something that makes you think you were completely wrong about when you bought them at 40, you were completely wrong and they should be 80? That you were so far off that you probably should have bought 10 times more of the stock because it's so much more valuable than you ever conceived of? Or is maybe that this is a good price now and that you should be happy to get it? You have to have an opinion on the stock, not just because the call's X% in the money. That's got nothing to do with this play. What matters is what you think is going to happen to Twitter, what you intend to do with it, how much of your portfolio it has, how well it fits in your portfolio, and what value you place on the stock. That's how you make a decision. Stop looking for easy answers based on percentages and this and that. That's not how this works. This is about deciding the right price for something, protecting yourself adequately, collecting the right amount of money when you make the money. That's what this is about. You guys watch me do this week after week, month after month, and we make consistent money all the time, and we don't do any of this stuff. But, you can't just always ask for like an easy answer to it. It's not how it works. You've got to do some work. You've got to get in there, and you've got to value things. That's what I do. When I make a change, it's because of the value of the stock, not because of some silly rule about an option being in or out of the money X%. It's not how it works. It's not how my system works. My system is based on solid fundamentals, on understanding a stock and having a good idea of where it's going to go from time to time. You can't just apply things like it's some kind of like a cooking recipe. It doesn't work that way. All right. So the two-thirds calculation, I'm saying, though, that if you are going to hang on to an option and it goes and less than one-third of it is premium. Okay, what's less than one-third being premium? Well, let's see. With Twitter, if we have the 35s, they're at $14, right? So that would be, that's 49, right? So 49 means there's no premium on those. So they're in the money and there's no premium. Now, that means you can't get a good roll. I can tell you already, because there's no premium, you're not going to get a good roll. So if you look ahead and you take those guys for $14 and you look at what can you roll to $14, you can roll them to the 38s. Is that right? Yeah, it seems funny. Okay, so you roll them to the 38s. And what I say they were, the 35s. So all you can do going from June to January is pick up like about $3 in position. But if you have the 45s, no, let's say the 40, I'm trying to get one that's right. All right, if you have the 43s at $8, that's 51. All right, that's right at the edge of where I would say you'd have to do it. So the 43s are $8. That's net 51. That means they're about $2.50 out of the money out of 8. So now we're just around that one-third mark, right? Now watch this. See, $8. Now you look ahead and say, where can I roll an $8 call to? The $8 call, you can roll up to the 50s. You spend 50 cents and roll them to the 50s. So I'm sorry, what were those? Those were the 44s, right? No. They were the 40. Oh, there you go. So the 43s, if you take out 50 cents out of your pocket, you can roll them all the way to the 50s. So you understand the difference, though? You get a $7 move, a $7 roll up in strike, because there's one-third premium left in those calls. But if you wait until they're all in the money, like the 40s are, or the 40 or the 35s are, if you wait till they're too far in the money, you're going to get a $3 roll. So your roll is way, way less. You don't improve your position when you make the roll. That's exactly what the problem becomes. So if you do intend to stick with a position, you need to make that decision, watch it when it starts getting close, and make the roll before it becomes a disadvantage to you. So hopefully that clears that up. But do not confuse that with me saying that you always roll when it's two-thirds. No, you have to look at it and say, this is what I intend to do with the position. That's what's most important. What matters is whether or not you need the protection anymore, whether you want to blow off the protection, and whether you want to spend money. Even the worst part, am I going to really spend money to have less protection? Because that's what you're talking about with June. Think about it, because you sold these things for $350. All right, so you sold these for $350, and now they're $550. All right. If you buy them back now, then you're the sucker paying premium. You sold premium, $350, but now you're going to buy back $4 worth of premium. That's insane. You're actually paying more premium than that guy paid you. That is crazy. That is the definition of being a bad businessman, right? It's like you take in merchandise in your store and you sell it for less than you paid for it, or you pay people to take your merchandise away because you're worried you might not make a sale. It makes no sense. And you're giving up the protection. You're giving up your ability to sell it later. Your job is to sell premium. And your job is to sell premium and then let the premium expire. That's your job. Never forget that. The whole reason you're here is to sell premium and let the premium expire. That's what being the house is all about. You know, the guy at the casino, imagine at the casino, Steve Wynn is sitting there behind the tables watching, and all of a sudden he takes your bet, and then he freaks out and gives you your bet back and gives you a bonus to take your bet away because he's worried you might get you might hit that number. No, that's insane, right? Because he's not gambling, he's playing the statistics. He lets everybody play and everybody spins, and he doesn't give a crap whether each individual person wins or loses, because he knows as long as lots and lots of people play, the odds are in his favor. That's the system I'm teaching you. Let them play out. The odds are in your favor. If you start trying to win individual bets because you think you're smarter than everybody, or you think you know things, or you think you know how everything's moving, then you are screwing up the system. You let the premium dissolve. And that, again, that's what we do in the butterfly portfolio. Look at it. I mean, this butterfly portfolio, we don't touch it. Where is it? We don't do anything with this portfolio. It just sits there. All right, it's up 30% right now. And again, these things, different times in the market, they change. But this is up 30% or so. And, and we don't touch it. Once a month, we make an adjustment. We sell, and all we do is we sell the next month. I don't care whether they're wrong or right. And you know how often people in chat say to me, oh, my God, what do we do about this? Oh, my God, what do we do about that? And what do I say pretty much every time? I'm like, nothing. You wait. Because sometimes things go up and sometimes things go down. And when you have 20 positions, some are going to be winning and some are going to be losing. But it doesn't matter because we're selling a ton of premium, and the premium will, in fact, expire. And that's all we care about. All right, so getting off that now. Rich says, what would you do if TZA is over 11 at March? I'm not sure I understand that question. I would be happy. Why would I not be happy? Let me see. Because we sold the 11s? Did we sell the March? Oh, we did. We sold the March 11s, right? Okay. Well, there's a case in which I'd be watching for the roll, right? Because we sold, I know what you're talking about now. So we sold 50 11 puts. First of all, realize we have 150 longs. So I don't really care if 50 of them get called away. I have a $2 spread, the July 9 versus the March 11. So I have a $2 spread on 50 of my longs, and if it gets called away, I'm around even on that spread. It's about break even. If I get called out, I don't get called away more than 2 because the Julys will have premium, the Marches won't. But realistically, what I will do, because if we look at the March 9s right now, they're deeply in the money, right? The March 9s are quite a bit in the money at $1. Oh, I don't know, $1.80, let's say, $1.90. Let's call it $1.90. Of course, we'll call it $1.90 because it's $1.80 in the money. So the March 9s are $1.90. What would I do with the March 9s if we're at this point and I say, well, gee, I kind of didn't want to get called away? Well, I'm going to look for where I can go in April, and the April 9 sucks, so I wouldn't do that. But if you look at July, I can go to the July 10s. So I could roll up. So now, don't forget, we're talking about the 11s in reality. So I would at least be able to roll from the 11s to the 12s. Okay, but that's also because you wait too long, goes the money. It's exactly what we were just talking about, right? You wait too long, goes too far on the money, you don't get a good roll. But even if I got a bad roll, I would be able to roll to the July and get another $1 out of that spread. That's even if it like blows me out of the water and it's higher. Like right now, this thing's $2 in the money to the 9s. I still can roll up $1 between now and July. So that's what probably, if it was over 11, we'd probably want to roll it along, keep it. But on the other hand, we might say, well, you know what, it went down, but we don't think it's going to stay down. Let them call us away and take the $1, and we still got 100 long calls. Wouldn't matter, right? You know, yeah, it's always, and you know, and again, that goes back to what would you do? I don't know, because we have so many other positions, right? We have our Qs, we have our other positions, we have longer positions. It depends on the overall balance. And you have to make a decision saying, how is this going to help me? Do I need to, do I feel like I'm too bullish, too bearish, not enough? Do I want to get some more cash out, whatever? And don't forget, by the way, in our last adjustments that we made last week on the FAS spread, we got very aggressively bearish on FAS. And that's actually what really hurt us this week in the portfolio in the short term, because FAS shot up on us. And we've got some naked, these guys, naked April 117 calls, and FAS is going. So we're losing, here we're losing we lost $1.09 today times 15. So we lost $1,500 today just on this particular thing. Oh, in fact, there it is. In fact, we rolled this on the 20th and we put $13.50, now it's at $14.50. So we lost $1 times 15, it's $1,500. We're aggressively short on the financials. We never covered that. So you have to look at every position and decide what your balance is and how you're going. All right, and Jal says oil is down going into the close. It's a little bit long time before the close, but it's weak. Let's see where we are. Oh yeah, rejected at 50, and now it's coming down. So now it's getting. But you know what? It's just not interesting. It's like you'll have to wait now and see what the inventories are like. With oil, the big factor is something like 20% of our refining capacity is offline because of strikes right now, and that's a lot. So if you think about that, that could pile up like 10 million barrels because if they're not refining it, then the oil is piling up outside the refineries, and if the oil is piling up outside the refineries, it's hard to say who's going to count that as inventory. It would probably be still counted as oil inventory and not be counted as gasoline inventory because it hasn't been opened yet, the barrels for refining. So there could be quite a large build in oil still this week. So that's like another strike we got to kind of pay attention to and see what's happening. And because of that, it makes oil a bad bet. Also because oil is a bad part of the cycle in the early part of the monthly cycle, it's also much trickier to bet on. So it's really just not even worth, unless it really gives you like back to 49, if you get right to the bottom back in the channel, or if you go high in the channel, it's not worth betting. I wouldn't bet anything in the middle here too much. It's just not worth the potential hassle. All right, and Dieter says, but if the option has no more premium and the stock hasn't increased percentage-wise, so what you lose on the swings when you win on the roundabout, what? Come on, I know you speak English better than that, Yodi. If the option has no more premium, the stock has increased percentage-wise, so what do you lose on the swings on the roundabout? I think he's saying that if the option has no more premium, the stock is obviously gone up in money, so you're still in good shape. And that's why I said you got to look at it as if you sold the stock for 50-50. When you sold the 47 for 350, you sold the stock for 50-50. So the worst thing that can happen to you is you end up selling the stock for 50-50. That's not a very bad outcome. So I think that's what Yodi's saying, in which case I completely agree with him. If he's saying something else, maybe I don't agree with him. Let's see. Paul says, so you on BNN said you're retired. I'm curious how much time you generally spend on your hobby daily. Well, I mean, now it's kind of a job. I mean, frankly, I thought I wanted to retire, but I didn't. It sucks. There's nothing more. I can never retire. I'm a worker. I like to do stuff. I used to have a company. My company had like 100 people. I used to put on a suit and go to the office and blah, 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 and that I gave up on. I started this. It was a hobby. I got into it. I figured I realized what I like doing is I like building companies. That's fun. So how much time do I spend on my hobby? I mean, generally, I'm usually up at like 3 or 4 in the morning looking at the stocks, and I usually hang out with you guys until about, in the chat room until about when the market closes at 4. So that's a good 12 hours. That's 60 hours a week, which is frankly less than it was a lot less than I used to work in my old company. I used to put in 100 hours easy. And really, when I retired, I was, what was I? It was 10 years ago. So I was about 40 when I retired. I sold my company, got a bunch of cash, and I had two young children. My second daughter had just been born, basically. And that was one of the reasons I wanted to get out also, so I wanted to spend time raising my kids. So now they're both teenagers. My little one just turned 13, and they want nothing to do with me. So frankly, I really don't have anything else to do now. So I'm very happy to be getting back into like the heavier work schedules. Generally I spent, when I first retired, I mean, I didn't start till stock world until like 2006, 7. And I wasn't pushing it. It was just for fun, really. When I started completely for fun, it turned into a bit of a business. And now I'm trying to turn it into something, but I'm also trying to turn it into something because I think it can be a nice little thing to leave for my children as well. So I'm still doing it for my kids generally. But for me, you know, I like doing it, so it doesn't matter. If I wasn't doing it, if I wasn't doing this, I would still be waking up in the morning and reading the financials, and I'd still be watching Bloomberg during the day, and I'd still be trading stocks. So to me, it's not even like, you know, I'm here and I'm happy to do it, and I love talking to people about the markets and stuff. So for me, it's just all kind of fun. So I don't consider it like really working 60 hours a week, but if I looked at it as work, yeah, I'd say 60 hours a week I'm putting into this thing. I think teenagers are the same everywhere, right? I mean, they just, you know, and I don't begrudge it to them. I was the same way. My parents were divorced, and I literally didn't see my father. I mean, not didn't at all, but I think really between the ages of like 13 and after college, I barely saw my poor father. I feel terrible about that now. I mean, we got really, really close after college, and I just really missed those years that I didn't. But he lived in Queens, and I lived in New Jersey, and you know, it just, and I had friends. It was like to see him on the weekends. It was like I would rather spend time with my friends. I didn't want to go see my dad. It was like I didn't want to go hang out with my dad and do something. I wanted to go see my friends on the weekend. So I really had very, very small amounts of time I would end up spending with him. And I knew that. So I guess when I had my own kids, I was like, I just want to spend as much time with them as I can while they're young. And now they've got their own friends, and they like to go out and they like to do stuff, and that's great. I want them to. They're independent. That was my job, was to raise them to be independent. And, you know, I figure when they get older, they'll come back, and we still hang out, actually. So we still have a pretty close relationship. But I'm just saying they've got better things to do than hang out with me. So I need to find something for myself to do, too. I don't want to sit around driving them crazy. And Paul says, what's your read on Greece? Don't say geez, why can't you guys figure this out? Chat to all participants. When you chat to all participants, please. What's your read on Greece? Do you think an exit will have major implications? I think the worst thing that could happen as far as Greece goes is that Greece does exit the euro and nothing happens, and it turns out to be a positive for Greece the way it was a positive for Iceland to get at, you know, to default on their loans. Because if that happens, then Italy and Spain are going to go, hey, we need to do this too, because we're buried in debt as well. I mean, all the debtor nations need to you know, say at some point there needs to be an adjustment. We're trying to inflate our way out of debt. Europe is weird because they're trying to cut their way out of debt through austerity. They hate inflation. The Germans have a pathological fear of inflation, which, you know, I mean, they went through some horrifying inflation, but, you know, it's like, get over it. It was like, you know, it was 60 years ago. It's not really, or 60, I'm sorry, it's like 100 years ago almost at this point. So, but they are pathologically afraid of inflation. So we don't have that thing here. In fact, and we're trying to inflate our way out of our debt. We're trying to inflate for our GDP so our debt is less a portion of the GDP and eventually hopefully pay it off. That makes sense. Austerity is a bitch, you know, and so Europe is trying to go down the austerity path, obviously not working as well as what we're doing. So the Greek exit, it's not $350 billion. AIG lost that much money practically when they went, you know, when they screwed up. So it's not going to kill anybody for Greece to default. That's not the issue. It's not about Greece defaulting. It's about the implications of the precedent that you set, where you say, okay, instead of going through this horrible austerity for the next 20 years, Greece just defaults, says screw you to all the people who owe them money, who they owe money to, and gets on with their lives and has a nice, happy time. Well, then how do you sell austerity to Italy after Greece does that? That's why no one wants to let Greece out. And that's why they're putting horrifying pressure on these people. I mean, they really are. They're just forcing Greece to go along with this thing. Greece went in there and they were going to default. They were happy to default and leave the euro. What happened is over the weekend, all these finance ministers and all the PMs got together and they just told the Greeks, they're like, this isn't going to happen. We will screw you over completely economically. We will sanction you, blah, blah, blah. They just said there's no way you're getting out of this debt. Because they can't. They can't let people default on the debt. Because if they do, there's plenty of other people who want to default on their debts. So that's the implication. If Greece does leave, which they won't because nobody's going to let them, but if they did leave, that would be the implication. As it stands, there's not going to be any implication. They're going to refinance, recast, do whatever. They're going to do whatever it takes to just keep Greece spinning along as long as possible. Anyway, all right, so where are we? Okay, let's see what's interesting. Look at it. TLT is flying up now. We're in good shape, so we are going to be able to get that short. We'll just have to see what happens. So tomorrow we have more Yellen, so tomorrow might be the day when we want to do something about TLT. And if we look at it, so, you know, you give it 6 weeks and you figure it's going to calm down. So sometime in April, and it's at 130 now. And see, look at that, the 125 puts in April are $1.50. I mean, they're not even $1.50. So that's a good way to play, because the chance of TLT coming down $5 is pretty good in 45 days. Because, you know, right now you have this catalyst, Janet Yellen, who's pushing TLT way, way up to the top, okay? So, and again, I don't want to do it today, but if we could sell the 135s, I'm sorry, the 130s. So we're at 130 now. The 125s are $1.50. Down here, 125s are $1.50. If we can get up to 135 and we can sell the 130 puts, not sell, buy, the 130 puts for the same $1.50, the chance of pulling back to 130 in 45 days, there's 30 days, there's 45 days, okay, so the chance of pulling back below 130 in the next 45 days is pretty damn good. All right, and if that happens, that could be, that could be nice money on those short puts. But you know, look at the way it goes up, and you always want to look at that. When you think you're going to bet on a pattern repeating or something like that, look what actually happened though. They're going to get over this support, and we don't want to bet here to go short because it's probably going to punch through for the Yellen's testimony tomorrow. They'll go over here. They're very likely going to get all the way back up to the top here and challenge this area, the 135, 140 area. And it probably is going to take a while. It might take, I don't know when Yellen's last testimony was. It wasn't to Congress, though, but the last Fed stuff and whatever they said. I know in October the Fed said some really nice stuff here. And then they had a meeting here, and it popped up after the meeting. But look at how long it took, okay? It went from 122 to 138. So here we are at 125, and we're just starting that kind of cycle off positive Fed news. So I certainly wouldn't rush into this bet, but I'm saying that down the road, I think it's probably going to be up here, and we'll see what we can get out of it. It's going to be an interesting way to play it. But it's just too early. It really is. You can't assume it's going to right away snap back. If, however, we got a ridiculous pop up to 140, like tomorrow, then I would want to short it. But I think there's going to be a slow build, just like this slow build, and you're going to see something in this range. And when you'll see it topping out. It's not going to be a mystery. It's going to top out. It's going to run out of gas, and then it's going to be kind of a good time to start shorting. But we don't want to get in too early. That's a mistake we made last time. We got in here at 130 because we thought this pop was going to be it, and it turned out that we missed it by $8. We still made money because we stuck with it and rolled it up, but we could have had a better entry. So now I'm going to be patient and see if we can get a better entry. All right, back to the charts. So the dollar's down. The dollar's down a bit at 94.50, sorry. Gold is back to 1,200. Silver's at 16.25. Gasoline is down, coming down. The VIX is no worry at all on the VIX. That's way down there. Natural gas back at 290 is too tricky to play around here. It's not in a good channel. Here's Brent is back down to this 22 support line. So that might be good for oil as an interesting test. And oil is down at 49.40. So I think 49. If 22 holds on Brent, BNO. So if this 22 line holds on BNO, then if we're down at 49 on oil, it's going to be kind of a fun play to play bullish as long as this holds. So that could actually be an interesting way to play oil long. But you see what I was talking about before. It's a good thing we weren't playing long at 50 because we'd be screwed right now. It's like way down. It's down 75 cents from where it was. But you got to pick your spots. And you don't want to play the middle of a range. You want to play the bottom of a range or the top of a range, not the middle. So the top of this range is up here, short-term range. The bottom of the range is actually below this line at 48.75. So it makes no sense to play at 50. You're right in between the two. All right, so we're getting ready to cut this thing down. Anybody else have any exciting questions or anything important needs to be asked? Last chance, folks. With the VIX low and the S&P overbought, is now a good time to roll an SDS position? It depends on what the position is. So are you talking about the SDS position that's in the short-term portfolio? Do we still have that? In the $25,000 portfolio? Let's see how that guy's doing. There's always conditions, because you have to think of, like, why, why is this position here? So in the $25,000 portfolio, we're not protecting anything. Why take the lead from Brent? We're not taking the lead from Brent. We're taking the signal from Brent to say, well, Brent isn't breaking down, so why would our local oil be breaking down? Now, we know why our local oil is breaking down, because there's refinery strikes. We just talked about that. But 49 is a pretty good support level. So if Brent is holding their support, then we can assume our support will hold. Now, on the other hand, if we're holding our support, I would assume Brent would still hold support. It depends who gets the support first, right? Brent happens to be at their support before we are. So that's why we're taking the lead from Brent, because they got there first. Where were we? $25,000 portfolio, right? Let's see. So in this particular portfolio, we're not protecting anything. These are all bets. All right? So this bet is not going well for us. But I mentioned this to somebody in chat the other day. We spent 35 cents on this, so we spent $350 on this position. It's a bet, though. It's not insurance. If we roll it and spend more money, it still has until March. It still has more than 3 weeks left. That's 4 weeks left, basically, on this trade. If we don't want to throw good money after bad, essentially. Okay, it's a bad bet. It hasn't worked out. It went down. We're down $250 so far. To roll it is to spend another $150, $250 to do the same bet that we have already been wrong on. And frankly, if that bet between now and the next 2 weeks doesn't pay off, we'll be down another 100 and something, $200. Whereas this bet can't possibly lose more than another $100 the way it is. So on the whole, on this particular bet, it went down fast enough. I don't want to do anything with it. I just want to see if it bounces back a bit. If it bounces back and situation changes, I might want to do something with it. But at 9 cents, I'll just be happy if it gets back to like 25 cents when we get out of it at this point. All right, EWJ, similar thing. That went the wrong way on Japan, but it's also kind of, where's the Nikkei now? The Nikkei is at 18,660. It's a little higher than we thought it would be, but it's certainly not out of the money. It's at 1232. It doesn't have to fall very far to put us in the money. So no change on that one. And again, we have a month left. Next week I might feel differently, but right now we have a month left. The UNG play is completely in the money, no problems there. That's going to be good for a nice fat gain. And USO is a little bit lower than we want it to be, but we have all the way until April to get to 19. So this position's fine, this position's fine, this position not scary, and this position not going well, unfortunately. So we will see what happens. But you see what? If you look at and again, it's because we make different kinds of positions. This is a long position and a long position. These are two short positions. What happened? We gained 1140 plus 340 is 1480. Minus 3 is 1180. Minus 320 is 1160, 860. Minus 2, whatever. So on the whole, we're up about $500 on our 6 positions. And it's a $25,000 portfolio. We're at $500 on 6 positions in what? Since the 10th. In 10 days. That's fine. They can't all be winners. In fact, they literally cannot all be winners because we bet different directions. We bet market down, we bet S&P down, we bet Japan down, we bet gas and oil up. They can't all win. They're not the same bet. But you know what? They can't all lose either. And because we took sensible positions, very small bets here, didn't lose much money, bigger bet here where we're beating the house and selling more premium than we bought, that's how we ended up making money. We make money, and again, we make money on our being the house sensible positions. We lose money on our gambling positions. This is not surprising. The gambling is fun, and one day we'll get it right and we'll make a lot of money. But you got to know when you're gambling. You've got to allocate your gambling and know how much you're putting into these things. All right, so, and last question is from Chrissy. You said oil inventory stake orders have been rolled down, so how can oil move above 50 if the inventories are too high? There's always fake orders. It's a question of how many. And there's a lot of fake orders, but there's no pressure for them to do anything about their fake orders until the last 2 weeks of the month, of the cycle. The cycle ends on the 20th, so sometime around March 6th, which is probably a Friday. Let me see. Yeah, there you go. So March 6th is a Friday, so starting around the 9th, that's when the contract pressure begins to build. That's when they have 10 days left to get rid of all these contracts, and plus it's going to be St. Patrick's Day, so that's always crazy anyway. So you have 10 days starting on the 9th to get rid of the contracts. That's when they start having the pressure. Until then, the contracts don't really mean much. But the contracts do come into play, and we like to watch it so we see what's going on. Wayne says, do I think gold is going down further? I hope it does, because we'd like to buy some more gold stuff. But I really don't see anything lower than 1150. This is a point at which I seriously like buying gold. I like buying ABX. I like buying ABX, HMY, and NAK are my favorite gold plays. NAK is very speculative, and ABX is still very low, though. ABX is by far my favorite gold play. They're hanging out about 1250. HMY, I think, went way up, so I don't think they're playable. Let's see. Well, came down a bit. So HMY is a little under 250. I like those guys. And then you've got NAK is very speculative. They're in Alaska, and they've got I think they might be going to break out, though. I think they're doing okay. When they were down here, nobody would listen to me. Now people, then they popped up and everybody started asking me again. I like these guys. I think they've got a gigantic gold reserve. They can't do anything with it because of all this environmental bullshit. But now we have the Republican Congress and the Republican Senate, and we might be able to, get rid of that pesky EPA and start drilling, start digging. So, if they can strip mine Alaska, that'll be fantastic. that's kind of what you're betting on. And if they do, but they realize they can get their approvals and they can do whatever it takes and start digging up that gold. There's a lot of it there. Gold, and it's gold, copper, and molybdenum, however you pronounce that. Those are the things that they have in there, and they're in incredible amounts of it out in these open mines. Very easy to get to, but unfortunately, it's an environmental nightmare where they have to dig and they can't get the permits, and nobody wants them to do it because it'll destroy the environment, But that's, if you're not investing to be an environmentalist, you're investing because if they do get the permits to do it and they do get to destroy the environment, they're going to make a fortune. So far it has not gone their way ever. But as a speculative play, just in case it ever works out, I just like them. All right, so that's that, and I will speak to you guys again next week. All right, thanks for coming, everybody. Yeah, hang on 1 minute.